Hello, welcome to the series of GST Bytes, an initiative by the Bombay Chartered Accountants Society. I am Advocate CA Vaibhav Jajoo, Associate Partner with Dhruv Advisors LLP. I am based out at Ahmedabad and I practice in the field of indirect taxes. You would be aware that GST Bytes aims at disseminating knowledge through the medium of short videos. In today's session, we are going to discuss the key clarifications white circulars issued by the Central Board of Indirect Taxes and Customs on 26 June. These circulars were issued to clarify and effectuate the decisions taken at the 53rd GST Council meeting held on 22nd June. To start with, Circular 210/2024 provides clarification on valuation of supply of import of services by related person where recipient is eligible to full input tax credit. To understand this clarification, we need to quickly understand few concepts in the background. We need to first understand who is a related person and who is a distinct person and deeming concepts of supply and valuation in case of transaction between such related and or distinct persons. Explanation to section 15 of the CGST Act deems related person to be person who are officers or directors of one another's business, person who are legally recognized partners in business, employer and employee, any person directly or indirectly owns, controls or hold 25% or more of the outstanding voting stock or shares of both of them. One of them directly or indirectly controls the other. Both of them are directly or indirectly controlled by a third person. Together, they directly or indirectly control a third person, or they are members of the same family. Distinct person refers to the individual with distinct GST identification numbers associated with a single legal entity that is having single PAN, whether located within the same state or across two different states. This would typically encompass different locations such as head office, branch office, factory, or premises from where services are provided of the same legal entity in India or having separate GST identification numbers but having common PAN. Entries 2 and 4 to the Schedule 1 to the CGST Act deems the transaction as supply of goods or services between related and distinct persons even if made without consideration. Further, Rule 28 to the CGST rule provides for valuation in case of supply of goods or services or of both between distinct and the related persons. Rule 28 Sub-Rule 1 provides that where the recipient of the supply is not eligible for full ITC, the valuation shall be open market value and provides for determining valuation in case of open market value is not available. Henceforth, we will refer this term open market value as OMV. However, second proviso to Rule 28 Sub-Rule 1 provides that the recipient of the supply is eligible for full ITC. The value declared in the invoice shall be deemed to be the OMV of the goods or services or both. Last year, in July 2023, Circular 199 was issued to clarify that in case of supplies between offices of same organization in two different states, that is distinct persons, and where the recipient is eligible for full ITC, value of taxable supplies shall be the value mentioned on the invoice in case invoice has been issued, and nil value in case where the invoice has not been issued. The instant circular clarifies that the second proviso to Rule 28 is equally applicable in respect of import of services by related domestic entity, where such recipient entity is entitled to full ITC. Hence, value of such supply shall be deemed to be the value mentioned on self-invoice raised by the recipient domestic entity, nil value in case where such self-invoice has not been issued. It is also clarified that the said valuation deeming provisions equally apply to transactions between related persons located domestically, wherein the recipient is eligible for full ITC. This is a welcome clarification as it will put to rest the litigation around demand for valuation in case of transaction between related parties. If you are aware, of late, investigations and tax demands have been raised on Indian entity alleging the deemed receipt of services like usage of IPR, typically brand name, trade name, logo, etc. This was typically in case of multinational banks, employee secondment services, etc. to its from its overseas affiliate where no consideration was ever exchanged. So there was no charge being done by the Indian entity and no consideration flowing from the overseas entity. This clarification puts to rest the question around valuation of all such services wherein the recipient entity is entitled to full ITC. It also reinforces that the valuation principles also squarely apply to transaction between two related entities located within the taxable territory. Next set of two clarifications is from the input tax credit perspective. First, we'll dwell into Circular 211/2024, which provides clarification on time limit under Section 16, subsection 4 of the CGST Act in respect of reverse charge mechanism supplies received from the unregistered persons. Again, we will take a quick snapshot of the background for this clarification. In case of supply of services from an unregistered supplier, where the recipient is obligated to discharge GST under the reverse charge mechanism in terms of Section 9, subsection 4 of the CGST Act, the recipient is mandated to issue a self-invoice in terms of Section 31, subsection 1, clause F, and discharge GST and avail the ITC based on such self-invoice subject to fulfillment of conditions for availing ITC. Section 16, subsection 4 of the CGST Act provides that a registered person shall not be entitled to avail the input tax credit in respect of any invoice or debit note for supply of goods or services or both after the 30th day of the November following the end of financial year to which such invoice or debit note pertains or furnishing of the relevant annual return whichever is earlier. Under the subject circular, it is clarified that the time limit for availment of ITC under the provisions of Section 16, subsection 4 of the CGST Act shall be the financial year in which the recipient invoices the self-invoice, and the same shall have no nexus with the receipt of service or invoice issued by the unregistered supplier. We will understand this issue and the underlying clarification with the help of an example. Say, if the recipient of service is obligated to discharge GST under the reverse charge mechanism and had received the services, say, during financial year 22-23 or 23-24, that is, in the previous financial year from the current one, and the said recipient has not issued self-invoice and consequently not paid GST under the reverse charge mechanism due to any reason, say, for example, it was a miss or an omission, ignorance, interpretation issue, or even an instance of being pointed out by the revenue authorities, and such person, on realizing the non-payment of GST, pays the GST under the reverse charge mechanism and raises the self-invoice during, say, the current financial year, then the time limit under Section 16, subsection 4, shall be reckoned from the date of issuance of such self-invoice, that is, current financial year 24-25, and will be eligible to avail the credit till 30th November 2025 or date of filing of the annual return for financial year 24-25, whichever is earlier. Here, the department used to take the view that the time limit under Section 16, subsection 4 shall be considered from the date of receipt of services. That is, in our example, if the services are received in preceding financial years, that is financial year 22-23 or 23-24, and therefore disputed the availment of ITC as being time barred through, though paid by the SSC in cash along with interest. Now, with this clarification, the ambiguity as to consideration of date of provision of service from unregistered supplier or the date of self-invoice for determining time limit for availment of ITC as per Section 16, subsection 4 is clarified and put to rest. Of course, the ITC will not be eligible if paid in accordance with provisions of Section 674, that is, for reasons involving fraud, willful misstatement, or suppression as specifically restricted under Section 17, subsection 5, read with Rule 36 of the CGST Act. Rest in all cases, the ITC shall be available subject to fulfillment of conditions for availment of ITC. In cases where the said self-invoice is issued after the time of supply, the recipient shall also be required to pay interest on said delayed payment of tax. Further, delayed issuance of invoice by the recipient may also be liable to penal action under the provisions of Section 122 of the CGST Act. The circular resolves interpretational ambiguities concerning the eligibility and time limitations for availing ITC under the reverse charge mechanism in case of supplies from unregistered suppliers. The recipient of service from registered suppliers where no self-invoice is issued, but the applicable GST is paid by the recipient under the reverse charge mechanism will be governed by section 16 subsection 4 basis the time of supply determined based on the date of invoice issued by the supplier or the provision of service as the case may be, in light of the fact that the circular specifically clarifies only the instance where the self-invoice is required to be issued for supplies from unregistered supplier. Now we will dwell on the second circular relating to ITC, which is Circular 212/2024, which provides clarification for mechanism for verification of proportionate reversal of ITC for post-sale discount. Typically under the industry, post-sale discounts are offered by two mechanisms. One, via commercial credit note, where only the discount portion encompassing the sale price or consideration is offered and no reduction is offered towards the GST collected. And second, where the discount also encompasses the corresponding attributable proportion or portion of GST, that is through GST or tax credit note. We would be discussing the second aspect of discount. Section 15 subsection 3 of the CGST Act allows exclusion of post-sale discount through issuance of tax credit note from the value of taxable supply, basically allowing adjustment of GST proportionate to discount towards the liabilities. This exclusion is contingent upon a condition requiring the recipient to reverse the proportionate ITC. As on date, no mechanism is put to place towards verification of such ITC reversal. It has now been clarified that till the time a functionality or a facility is introduced on the common portal for verifying compliance of such condition, a supplier can obtain an undertaking that the recipient has duly reversed the proportionate ITC pertaining to the credit note by the supplier in cases where the GST and compensation cess involved in credit note does not exceed 5 lakh in a financial year. If the amount of GST and compensation cess involved in credit note exceeds 5 lakh in a financial year, then a certificate from a CA or CMA to the effect that proportionate ITC has been reversed by the recipient will be required. Here it is important to note that the threshold of 5 lakh is only considering the amount of GST and compensation cess involved in tax credit note during a financial year and not the amount of discounts. Such undertaking or certificate can have details of credit note, corresponding original invoice, and the amount of ITC reversed against each credit note. This should be accompanied by details of Form DRC-03, return, or any other relevant document used for such ITC reversal. Further, it should have UDN generated by CA or CMA as applicable. Undertaking or certificate shall be deemed sufficient and admissible evidence for the purpose of section 16 subsection for the purpose of section 15 subsection 3 in any proceedings including scrutiny, audit, investigations, etc., including those pertaining to the past periods. There was increasing litigation and arbitrariness around evidence sought by the revenue authorities towards such reversal of ITC by the recipient taxpayer. The clarifications appear to be based on the directions of the Honorable Rajasthan High Court to the GST Council in case of Tata Motors versus Union of India, wherein the dispute was pertaining to eligibility of GST adjustment of the supplier, that is appellant, considering the lack of evidence about the recipients reversing the proportionate ITC towards the tax credit note issue. The High Court directed the GST Council to consider the proposition of allowing GST reduction based on CA certificate certifying reversal of ITC by the buyer. The clarification shall henceforth streamline the documentary requirements. It, however, creates an increasing burden on the suppliers to prove the bona fide of the recipient taxpayer. This is similar to the current situation as you would have evidence in case of mismatches in GSTR 2B vis-a-vis 3B, where such certifications were put in place by earlier circular. And we have seen the difficulty in getting such circulars from the suppliers And even the chartered accountant certificate, getting a chartered accountant certificate challenges a higher challenge. Where the certification is not received, the SSC can contest the demand based on ground of impossibility of performance. The last clarification which will be taken in GST Byte is circular number 207/2024, clarifying the threshold for filing appeals by revenue. The board has set the monetary limits below which the central tax officers shall not file appeals, applications, or special leave petitions. The limits are: in case of appeals to be filed before tribunal, 20 lakhs, High Court 1 crore, and Supreme Court 2 crores. How this limit is to be applied or computed? A clarification to this effect has also been provided. If the demand is towards the tax, which with or without interest and or penalty, only the GST amount including compensation cess to be considered, that is the tax amount. Interest and penalty will not be considered. If the demand is only towards interest or only penalty or only late fee, that is, there is no demand towards tax, then in such cases, the amount of interest, penalty, or late fee, as the case may be, to be considered. If the demand is pertaining to interest, penalty, and late fees, all together or any two together, here also the demand is not towards tax, then aggregate of the disputed demands will be considered. In case of refunds, the amount towards the refund. Cases of composite orders, that is, more than one appeal or demand notice being educated by a single order, aggregate of disputed tax, interest, penalty, late fee under the composite order instead of amount involved in individual appeal or demand notice. However, there are also exclusions provided to these monetary limit, where in the appeal shall be filed irrespective of monetary limit, so the department deholds the monetary limit. What are these instances? Where any provisions of the CGST law has been held ultra-vires to the Constitution of India, or any rule held ultra-vires to the parent legislation. Where any order, notification, instruction, or circular issued by CBC or government have been held ultra-vires to the enabling legislation. Matters related to valuation or classification of goods or services, refunds, place of supply, or other issues recurring in nature and or involves interpretation of law. When strictures or adverse comments are made or costs imposed against government department to their officers. Again, this one is interesting. Any other case where board deems it necessary to contest in the interest of justice or revenue. Non-filing of appeal as per monetary limit shall not be considered as precedent or deemed acceptance by the revenue or prevent officers from filing appeal in other cases with similar issues. This would mean that, say for example, the department has not filed an appeal for GSTR 2B 3B mismatch due to monetary threshold. That does not imply the department has accepted the issue or the matter, and the revenue officers are free to file appeal in other cases having identical issues which are not considered or which are not constrained by monetary limits. The clarification aims at reducing litigation by prescribing a monetary threshold to file an appeal by the revenue. However, it carves out several exceptions to which the threshold would not apply, leading to question the real rationale for this introduction. The exclusion by way of phrases any other cases in the interest of justice or revenue, or the phrase other issues recurring in nature, seems to widen the scope and could effectively cover reconciliation issues as well, which could clearly defeat the entire objective of this trade remedial measure. Total 16 circulars have been issued by the board. Certain circulars and clarifications are still awaited. We have discussed key 4 circulars. Other important clarifications pertains to tinkering of rate structure of certain goods and exempting certain services. Some important clarifications relating to insurance and auto sectors, and clarifications on place and time of supply are also there. Hope you find this video useful and stay tuned for further updates. Thank you and have a good day.